Good morning, everybody. Green on the screen around the world, led by Hong Kong. Um, Not up by much, but nearly 0.75%. So we should be able to find some of those China ADRs, most likely as a little bit of a mean reversion. Behind that, though, we have Europe and then the Russell, and then the US, the rest of the US markets, like NASDAQ, S&P, and the Dow, closer to flat than anything else. Japan down 0.25%. We're going to have ADP numbers today. This goes along with employment theme. It's all about jobs this week. There was a good article that I was reading over on Seeking Alpha, and it was just a kind of a big picture analysis of what's going on out there. I think the guy did a really great job. This chart in particular, U.S. job openings, put it in a new tab so we kind of zoom in on it a little bit. U.S. job openings versus U.S. job seekers. The openings are in blue and people looking for work are in red. And I kind of like how that looks, you know, that there's more jobs than people looking for jobs. Kind of leans into those JOLTS numbers where we were talking yesterday. The take this job and shove it numbers. How comfortable are you with the idea that you could find employment if you lost your current job or quit your current job? And looking at this, that sounds pretty good. You do have to be careful though, you know, with something like this, because it doesn't say what kind of jobs these are. Is it a bunch of, you know, service jobs, labor jobs? So, you know, at first blush, this looks great, but it's not all of the data. We're going to continue to get jobs data all week. So ADP today, initial jobless claims tomorrow, and then the big one on Friday, the non-farm payrolls. These numbers out of Japan tonight could provide a little bit of insight or some volatility as well. It doesn't show that, but yeah, just, you know, really think about what you have in your portfolio. And when it comes to cutting rates, it's not just in the US. Traders are pricing in 150 basis points of interest rate cuts in 2024 in Europe. 125 basis point cuts are getting priced in to the US, or five cuts next year, basically, is a good way to say that for the US markets. No matter what the Fed has said. And that's kind of the rub, because on December 13th, we're going to have an FOMC meeting. And if Powell comes out really hawkish, kind of pounding the table on the idea that, look, man, we're not cutting, then the market is going to probably throw a little bit of a temper tantrum. So we'll just have to see. But that's the biggest threat to any sort of rally that we've got going on out there. Here's the spot gamma levels if you want to take a screenshot. Volume's in normal range, and they're not hedging in this morning, so they're not too scared of the ADP report. The expectation is that these numbers could provide a little volatility, but it's not enough to cause them to stress and to hedge. We're still underneath this critical level. You can see that we haven't even touched that proximal line yet. It's a RBD, rally-based drop zone. It's only a 2-bar because we're on a weekly, but if we were to go to a daily, that would have a little bit more context to it. If you look at the fangs, they made it through this, right? They were able to get past it, and it's not, the all-time highs. It's just year-to-date highs. We have managed to stay within last week's range. And we're back above that 50% mark. So 45.76 is the line in the sand that I had mentioned earlier in the week, is the level we really need to stay above at the week's close. So how this candle closes on the week. These two with the wicks down below really show those buyers stepping in, defending the level. We continue to hold underneath that call wall. And we're back above the volatility level, volatility trigger. It did move. That's not where it was yesterday. We've distanced ourselves a little bit from the 10 MA. That's a 10-day moving average. If we did cut through the daily pivot point, then we're going to have to contend with that 10 again. Yesterday, we had a really tight range-bound market. Crazy boring day. One of the things about having a really tight market like that is that it generates energy. And we learned that by using an indicator called the RSI Laguerre. I have it. If you don't, just hit me up. I'll give it to you. It's in the Thinkorswim workbook as well. And it even various versions of it, because the guy who helped develop it, Mobius, built in some trading logic into it, which is pretty cool. So there's different versions. Some have a 2-period RSI, kind of like the way it was developed by the RSI creator, but it has a smoothing factor to it. So it's like all in or all out, magnetized across the top or across the bottom. And when paired with RSI Laguerre, it offers some pretty cool signals. The thing is, with that indicator, we learned that when a market is range bound, it's building energy, kind of like putting gas in a gas tank, so that when we start to make a move, we can gauge how much of that energy is being used in the move. And the analogy that I like to use is throwing a ball. You put energy into it, you throw it, and as the ball moves, the energy dissipates. Well, that's different than throwing a ball off of a roof, off a tall building. As that ball moves, it's picking up energy. So when a market makes a move, like this leg out that we had at the start of the Globex session, we can use that indicator and look at that move, and we can tell if the move was done to generate energy or if the move was done with energy behind it, which helps us try to identify when we get into resistance, are we moving with energy that can push through that resistance, or is the energy dissipating? We're going to hit that spot and fail to get through that resistance. Pretty neat, right? Yeah, I'm a nerd. We're struggling with the weekly pivot point. We're back underneath it this morning, but we're really trying to get through it, get above it, begin to expand beyond it. We spent most of this week underneath that weekly pivot point. This is a transition phase I'm going to set this chart just a little bit higher so that we can see more of those weekly pivots. And I get it. This is a really noisy chart. Here is the weekly pivot, and back here was the weekly pivot. We had been staying above it, and even this week before that one, we were above it. So that was 3 weeks. We were just holding above, holding above. Finally, we got tangled up in it last week, and then we got underneath it most of this week. When we're above it, we look for bullish opportunities. When we're below it, we look for bearish opportunities. When we're tangled up in it, it's a transition phase. There's no edge on trying to take longs or shorts on a swing basis here. It's just trying to wait out the storm and the chop until the markets start to move again. And you can see it's been 2 weeks of this choppy, sideways, nasty market. This has not been enjoyable, right? Closer to 3 weeks, which really, when we zoom out and look, since the November 14th, really, we've just been chopping in this mess. And don't get me wrong, there's been some really great trading opportunities, but not as much as I'd care to see. And in the equities outside of these indexes, there's been some fantastic trading going on. So the reason I bring that up is there's so many things to trade. Look at gold or oil, right? There's always something to trade. So if you're trading futures, maybe look at some of the other things out there to trade. And if you're trading equities, I mean, hey, I like SPY and the Qs as much as anybody, but there's always something to trade besides this sideways trash. Ten-day, 30-minute volume profile. I mentioned yesterday that the range was getting tighter and tighter. We've got basically a 70-point range here, maybe 80. 70 seems about right. That's a very tight range in a 10-day period. It is the classic D shape, but you could almost argue that we're starting to build the lowercase b, right? So really nice shallow area above. We've seen that we can cut through those zones really fast and that there's nothing to hold us there as well. And we can fall right back down again. We are looking at the point of control as some sort of support, not in the sense that we can come down and hit that line and bounce off of it per se, just from the idea that there's a lot of unfinished business there. And traders seem willing to participate at that level. So whether it's buying or selling, the answer is yes, because it's both. That should we come back down into that point of control, we're going to expect the same thing again. A lot of trading activity and a pause at that level. Think of yesterday for an example, when we were just sitting in that zone yesterday, chopping about. If we put it on just a normal everyday 5-minute chart, it doesn't look that bad. We spent a lot of time there, right? Just kind of holding above VWAP, like a VWAP program was in play. And every time we came down, the VWAP program activated. There was a lot of trading done here. And eventually it would drive us away from it. They turn the program off. We drift back. It starts buying again. Just a normal everyday VWAP algo buy program. And when that was finally done, we took off. Okay. That makes sense. Put that on a tick chart. Tick charts represent a trade that happened. So this isn't contracts, it's not volume, it's how many transactions took place. So this is a 3,500 tick chart. After 3,500 transactions, we'll get a new candle. Now that can have one contract per trade or 100 contracts per trade. It doesn't matter. It's just how many times did the trade take place. Now you can see that VWAP wasn't so strong, or at least the VWAP, wasn't this solid line in the sand that it looked like on a time-based chart. And remember, VWAP is a little odd when it comes to the way indicators work. VWAP's location doesn't change. If I go to a daily, a weekly, an hourly, a 5-minute, VWAP is VWAP, which is weird, right? Because you look at a moving average on a 5-minute, and then you look at a moving average on a 10-minute, it's in different locations. But VWAP is VWAP, no matter what you're on. But this kind of takes away that algo argument that we were just discussing. This also shows a willingness to participate. So almost like passing the buck, right? A couple of institutions were exiting a position and a couple of other institutions were building a position. And so they were happy to just sit here and swap and get their work done. The reason I bring this up is because we don't tend to think about it that way, right? We tend to think about things as in, oh, it's bullish, oh, it's bearish. When everybody is on one side of the fence, everybody's buying, oh, that's a really easy trade, right? Because, I mean, there's nobody going the other direction. You can have the worst entry and get stopped out repeatedly and still just keep getting right back in and doing it again because the flow is bullish. There's nobody selling. No institution is going against you. And it's just a single shot, one time framing. Same thing in the other direction. If everybody's selling and nobody's buying, then it's just a straight shot. No matter how many times you screw up that entry, you can come in and get another shot. So this is what I refer to as doing the easy stuff. Quit doing the hard stuff and do the easy stuff. We don't always know when it's the easy stuff or we don't have the patience to wait for it. But yesterday, as tradable as it was, there's always opportunities to trade. This is considered more difficult to handle than something like that, where you have one-time framing, single directional push that lasts candle after candle after candle after candle. It just keeps right on going. So if you're losing more often than you win, quit doing the hard stuff. Do the easy stuff. I carried over that VPOC yesterday on the idea that it wasn't really much of a VPOC. It really had been tagged at the Globex Open, but I left it on there just to see if we were going to interact with it and if there would be any noticeable change in market behavior when it got around that level. And I would say, no, there really wasn't any. But, the textbooks when it comes to volume profiles say that we should carry it forward, whether it's been touched or not. And I don't normally. I just keep track of the VPOCs, but I'm a firm believer that I don't know everything and that I'm not always right. And so while I do focus on VPOCs, there's a reason that people wrote books and teach using this thing from a point of view that says you should carry forward those 3 levels: value area high, value area low, and point of control, whether they've been hit or not. So I tend to, take a look at that and just believe that it's worth looking at other points of view. I didn't see anything out of it, by the way, yesterday. It was just worth looking at just to see if we could get something out of it. We got kind of the same argument again today. If we look at the VPOC from last night and we look at how we opened, when we opened, we came right down and tagged it. So the very first candle yesterday. So the argument still exists. Is that technically a VPOC? I mean, no, it's been hit. So it's not a virgin point of control. but we didn't close below it. And it was basically a knee-jerk reaction from the market open at Globex Open. So I'm going to carry it forward anyways. There's no perfect answer to this, by the way. I bring up this sort of thing because, when it comes to technical analysis and approaching the markets, you have to, at some point, you have to make decisions for yourself. You can't just lean on what somebody else does, because there's always going to be a little nuanced thing like this that hasn't been covered somewhere. And then you just got to make a decision. Me, I'm interested in how price is going to react if we come back to this level. So whether I call it a VPOC or not, or just look at it as a point of control, because it is the point of control, I'm going to keep it on there and see what price does if we do come back to that level. Technically, however, it is no longer a VPOC. We're doing a really good job of maintaining inside our weekly expected move. I'm almost impressed. Of course, it's been, a sideways market, so it's not that bad. Today is the struggle day. Monday is the candle in control. We're now through the 50% mark, but this candle needs to close for that to count. So we want to focus on that, how the market closes today. And if we maintain above 45.79, the thing is, we got a whole week, right? It's not just this one candle. Remember when we were talking earlier about the weekly candle, 45.76.25, 45.79. That's, you know what I mean? That's pretty close. So yeah, I would look at it as a zone from 45.79 to 45.76. That's a 3-point zone in a $4,600 product. We also do still have yesterday's candle and just a magnificent doji, no less. 45.70 is the 50% mark, or the halfback. This daily chart has a lot to be encouraged or inspired over. You can see all this buying down here. Those buyers were really defending that level. But that 2-bar reversal is a little bit concerning. And we're still trying to get back to Friday's close. But we are maintaining our weekly range. Even though we left the range twice, came back inside it. Now we're trying to reclaim the candle of control, Monday's candle. And if we can do that, if we can keep it, then we'll focus on Friday's close and maybe 46.50, which would get us back up here to that green. There's just the job numbers, right? Oh yeah, just those. Those numbers are going to be the most watched thing, and they're going to be the biggest impact to this market for the rest of the year. I know that sounds kind of dramatic, but the Fed is going to look at those numbers, and it's going to give them the excuse that they need to do whatever it is that they want to do. So the December 13th meeting on whether or not they're going to come out pounding the table really hawkish and shake this market to its foundation or not is very likely going to be predicated on those job numbers that we get. So if you're looking at any sort of swing trades, or you're holding any swing trades, ask yourself what it would look like to your Amazon short or an Apple long position, if the S&P was to move 6%. Now, that's called beta weighing, by the way. If you're holding, even stock, you can do it, but usually it's done with options. If you're holding a lot of positions of different things, you can turn all those things into the same thing so that you're comparing, apples to apples instead of apples to Oreos. You just basically turn all your deltas into SPY deltas and then measure how much your portfolio would get impacted if SPY was to move 3% higher or 3% lower. Because that's what we could see between now and the end of the year. This is the SPX. I don't normally show the SPX in the morning briefing because it's not open yet. It's not moving. The thing is, we still have our expected move model. So if we look at Wednesday, Thursday, Friday, December 8th, and we look over here to the right, we've got a 15.03 average implied volatility for the December 8 series. I like to round here because going to the penny is worthless. This is a $45 expected move, higher or lower. Put those two numbers together, that's $90 up, $90 down that we could move. It's not even counting the market maker move, which is an additional $26 because that's a plus and minus as well. So that's well over a 100-point move between now and Friday, let alone what we could do between now and the end of the year. It's got a $117 expected move. We can just round again, bring that up to 120, double it, that's 240. $240 higher or lower between now and the end of the year. Even if we didn't double it, it'd be 100 points higher and 100 points lower. 46.24 or 44.24. That range right there. It's a 1 standard deviation move. So we got a 70% chance of closing inside of this and a 30% chance of closing outside of it. 15% chance that we close above it, 15% chance that we close below it down here. And again, that's for the end of the year. But that move is going to be predicated on these job numbers. All right, so we have the China ADRs this morning. Got a nice gap up in KWeb. So we would expect a nice gap up in BABA, which we can see here. We don't have a nice gap up in BABA. See if we got it in Baidu. Yeah, so Baidu's got that nice gap up. Really, we gapped down yesterday in Baidu, and then it rallied back up strongly. Closed, yeah, closer to the high than closer to the low. basically it closed just under the previous day's close. So not fantastic by any stretch, but it did show that it was trying to come back. And then this morning, another nice continuation from yesterday. After multiple days of just a beat down, this is trying to turn around. I would also recommend, if you're focused on these China ADRs this morning, to check around in the news and see if you can find anything that talks about some stimulus coming out of China. Did they, dump some monies towards that real estate issue? Are they, trying to ease policy somewhere? And usually we can find some sort of shadow stimulus. Kind of helps with the China ADRs moving around. But while BABA hasn't really flipped the script yet, we do have Baidu, and then there's JD and PDD. I like PDD. It's getting a lot more flows than the other ones we looked at. And you can see on the daily chart this really big blowout candle, and it kept it. A lot of times when we see a market make a move like that, it'll give it back again. And this didn't give it back. So it's looking pretty good. Let's go ahead and adjust this since we did make it to the level. So with PDD, 4720 is the line to get through at the moment. We got to get across that, and then we can continue to expand. I'd worry about 150. It's a round number to deal with. And if we can get through there, then we'll look left. There's some levels from the past to focus on. But that'd be just a good start. A continuation, though, really, of this beautiful move. And it's been a beast, right, since July. So the worry was that we were going to get a blow off top, fake breakout, fast failure, but that didn't happen. So JD, PDD, Baidu, not BABA. And I wouldn't try to lean into BABA either as, oh, well, the others have ran. Maybe this hasn't run yet, and I'll focus on that. Usually if we get a laggard like that, and we have a basket of stocks and they're all making the move except for one, that one is the outlier that you probably just don't want to mess with. There's a reason it hasn't moved yet. It's not a late bloomer that gives you an opportunity to jump in, even though you missed the run on all the others. It's just the turd in the punch bowl that you want to avoid, right? So I'd say just avoid BABA when you got all these others that are making a reasonably decent start this morning. So that's the KWeb group. Then there's the pot stocks. Maybe. There we go. Not overly heavy on the flow this morning, but they're getting a little bit. They are up. You can open a basket of stocks like MSOS and see the companies that are inside it and try to pick out those individual companies to trade rather than focusing on the ETF. Solar is also up this morning. Same thing. I'd rather trade the solar names than this solar ETF. Gold or precious metals. which makes sense if we see US dollar Japan fading away from this high or this resistance, that 147.5. If that does hold as a resistance and we continue to see this fade through the day today, we could see those precious metals continue to make that advance to the upside. The thing is, we don't want to see, precious metals up and the dollar up. So this is also something we're going to want to see take that rejection across yesterday's high and continue to fall. And with a falling dollar, you got to kind of believe that we're going to see a rising index. So we'd see the ES and the NASDAQ rise, which they're not yet. They're still under VWAP, but it's a good start. Let's get that 10-year to fall, get US dollar, the index to fall, the Dixie, US dollar Japan to fall. We can get that rising gold, silver. And we got Bitcoin proxies on the run this morning too with Nat Gas. Let's check out the Bitcoin stuff like Riot. Yeah, okay, that's not all inspiring, but it's up a little bit. Coin. Oop. I mean, you got to admit, that's impressive. It went from, $70 to $140. Yeah. It's going to have to digest this at some point. The question is when, right? Trying to short this is literally standing in front of a freight train. So, trade what you have, not what you want. So Riot, Coin, Mara. More thin would be something like Hut or Hive. Those are, connected to the Bitcoin. This is my crypto watch list. Just some really thin stuff in here. CAN is up 4.5%. BT testing against this high. It's yesterday's high. It's kind of the high on the week. It's a really beautiful wedge. And it looks bearish to me. That's my own little bias, but it looks like an inverted TRB, right? So it looks like those three candles or those three candles, but in reverse. Higher lows with a flat top instead of lower highs with a flat bottom. SQ is another one, and it's getting some solid flows this morning. So out of those Bitcoin proxies, Square looks really good compared to some of the others we saw. AMD is on that list, and it's fantastic. Nice continuation outside of yesterday's range. NVIDIA, yeah, it was gapped up. It's trying to fade off a little bit. Still higher than the close of yesterday. Careful with this. When we get those gapped up, like an exhaustion gap up and then dumps down. That was a really big move. Really big recovery candle yesterday. Outside bar. And MSTR, which is basically flat at the moment, but it's still in the Bitcoin space, so it's likely to get flows. A lot of them that aren't moving at all. And PayPal is actually not participating in this at all. Big gap down this morning. No, I didn't put this list together. This list came from Tasty. They had this thing called the Smalls Exchange, and they built these unique products that were literally the stepping stones to all of these micro products like micro Bitcoin and nano products and all of these new and interesting things. They had a Bitcoin product, kind of like a futures product, kind of like an ETF product. And what I did is I opened up their Bitcoin product because it's a basket of something, just like an ETF is a basket of something. I opened it up and took all the names out of that basket and built my list from that. So that's where this list came from. I didn't pick these names and decide that they were crypto. Tasty did. They're in some way related to blockchain, which means it's not necessarily, quote, Bitcoin. There are some nat gas products out there to focus on that are better than UNG. This thing has just been a soggy mess, completely worthless. This is nat gas futures, XNG USD. And we had this range that we were focused on, this kind of wedge down here. Beautiful breakout, and then it just all fell apart, right? This is like a fake breakout, fast fail, blow off top, capitulation, whatever, however you want to approach it. So this is up this morning, but it's not inspiring, right? The idea behind this would be if you have some nat gas ETFs that are up, focus on what's inside it. Companies that derive a lot of revenue from nat gas. And then GDX, these are gold miners. So companies that are, a part of mining in precious metals, gold, silver, those should be doing well this morning. Semiconductors are almost up enough to reach my benchmark. I use 0.5%, so they're not quite there, but they're on the right track. So of course, semiconductors, AMD, MU, TSM, NVIDIA. And small caps through IWM, really nice reversal after that big move that we had earlier in the week, or last week, I should say. It held the move, digested nicely, didn't give it all back. So I would focus on 50% of that red candle. And if we can get through that, then should get a really nice continuation, nice expansion. That'd be 185.55. We got to get through that. So really, compared to what we've seen, through most of the week, we've got a lot of things to focus on today. A rising tide lifts all boats. So we want to see this expansion in all of the sectors. And we can see that we don't have that yet. It sounds like a big ask, really, when you think about it. Like, man, all 11 sectors, we got to get them all up and running. Yeah, I mean, not all at once. And it doesn't have to be up 1% kind of day. This is not an overly exaggerated bullish morning. It's just spread out kind of nice into multiple directions, which is good. Yesterday was like all Apple, right? It was all the fangs, all Apple. And every time Apple paused, the market paused, which is fine, right? We'll take what we can get. Today, the fangs are up 0.5%, right at that benchmark. And it was up again this morning. Apple was up a little bit. It kind of gave it all back. We closed at 193.42 and we're sitting at 193.72. So we're barely up in Apple. But looking at that, that's a beautiful, like bull pennant. We're outside of the previous week's high. So we have an inside a week breakout. Here's our weekly chart. Big outsized bar. And we're through this second week's high too, right? That 192.93. We're through that as well. So we got to keep it. If we get through our own high of yesterday, that 194.5, then we'll focus on this 196. And then really it's $200 round number. That 198 is there, but I think we'd overshoot that if we actually did get into that 196. So 200 really seems to be on the table if we can get through 196. Look at it on the daily here. That was a beautiful red to green from Monday into Tuesday. That kind of red to green is exactly the kind of R2G play that I like. You can see how it recovered in the later part of that day, closed in the upper portion, and then carried that momentum into the overnight. Open gapped up, left a gap that needs to be closed still, and with no wick on the bottom of that thing, it just ran. Breaking out through key levels, through 50% of that, through the top of that, top of that, top of that. It's a beautiful R2G play. And it shows that kind of move. Short-term swing traders, afternoon opportunities are these. Right? That's what I used to spend my afternoons focused on, is trying to find candles on the daily that looked like that. And then people would say, I thought you were trading in the short term. Why are you on a daily chart? Because I'm looking for those, man. You get into that by the end of the day, and you're looking for that recovery the next day. Good thing is if it doesn't do that and instead it gaps down or it just closes and opens sideways the next day, it's not exactly toast, and you can focus on, managing the trade, converting it into a spread or rolling it or even just closing it, whatever. So Apple still looks really good. On the monthly, we are fighting with last month's high, that 192.93 again. But this is a TRB setup, and we're almost back. Apple is SPY and SPY is Apple. So if we keep Apple moving to the upside, we're very likely going to see the indexes, especially the Qs and the SPY, making the same moves. Microsoft R2G wasn't as good. It gapped down first and then rallied. Still has a gap that needs to be closed. We'll just take this line here. 374.51 is the gap that needs to be closed. It looks like we almost hit it this morning, but almost don't count. Hand grenades and horseshoes. And that's a really nice TRB as well. That would owe us back to these highs at 385. Close. Look at it on a monthly. This has just been a really nice continuation. That needs to hold for, man, we're so far away, it doesn't even matter. We don't even need to. Doesn't matter, too far. Google is another one gapped up this morning. A lot weaker on the hourly compared to the other two that we just looked at. An okay R2G, it gapped down instead of up like Apple did, but it did make the breakout. This gap is, I'm pretty sure, closed. Yeah, it's closed. But that gap is still there. So 132.53. The thing about gaps on these daily timeframes, some analysts consider a gap closed as soon as you touch the gap candle. Doesn't mean that, they're wrong and I'm right. It's just a different approach. So for me, where we closed, that's what we have to go back to have a gap that is closed. Since we closed at 132.53, the fact that we are in that candle or that we came back up and got to that candle doesn't make it closed to me. It has to come back to this point. You can choose whichever way you want to go. You just need to be consistent in whatever you decide. For Google, we want to get through this 132, and if we can, then we'll focus on 134. Yeah, 134. And eventually back to 138 because it's a very big TRB setup. Meta looks pretty rough. This is a very nice bear flag. I mean, textbook, perfect. The thing is, the longer the flag goes sideways like this, the more I begin to believe that it's not a bear flag anymore, that it's a failed bear flag. And then we'd be looking for a 786 breakover and a run back in the other direction. So with that in mind, if we can cut through that 321.5, that would be the trigger for a long play with a failed flag, which eventually turns this into a big cup, right? And then that gives us a cup with maybe a handle on the other side. We get that base, and then finally we break above, and it's a failed flag. It's also a TRB, gets us back into that 340 and 342 for Meta. We can see on the monthly just how fantastic it's been through the year and how it's been sitting up at this high now since really July. It didn't fall back like the rest of the market did, but it didn't continue to run either. It's been strongly holding this level, and I think it's got more in it. I think it can do the thing. So kind of watching this here on the weekly, that is a gap down that we need to resolve. Notice it's a hollow red candle as opposed to a solid red candle. So it shows that we opened lower than the previous close. And it also shows that we're currently higher than where we opened, which is why it's hollow. So 324.82 is the gap close from last week. We'll focus on that first. There is resistance at the previous week's low. You can see that that's what we've been hitting against. So we could focus on getting above that. That would trigger us long. And then we can focus on, getting that gap close and then 50%, 330. If I was going to get some out of the money stuff, I would probably focus on that 330 for us. It just depends on the liquidity, of course. Oh yeah, it's got plenty of liquidity. We've got an expected move of $27. So from 320, we could easily see 340, 345. Risk one to make four. The curve doesn't kick in until about 370. It's just too far out of the money. Yeah, it's way too far out. All right, guys. Well, that's what I got really. The fangs are up this morning a little bit, but a lot of these other sectors and groups are doing better. Nat gas, precious metals, including the miners, China ADRs, semiconductors, pot stocks, small caps, and Bitcoin proxies, and the fangs. That's a pretty good group. Be careful, be safe, keep your eye on the clock, and I'll see y'all tomorrow.